It's been a rough year so far. We'll start with the Federal Reserve. A, do you think they could do that, raise by 0.5% in March? And B, if they did, would it matter? Does it matter to you how and when they raise rates?
Well, ultimately, what's going to matter is when we re-enter this period of more normalized growth, is that because inflation comes down and the picture improves on its own, or it's forced by the Fed? What they do with one meeting is not going to matter, but certainly if they go out with a start at 50 basis points, I think we're going to see a little bit more volatility ahead. But again, as you said, the main message they've put out is that everything is on the table. They're going to remain flexible. And I think that's why the market keyed off things. Last Friday, it was about earnings, and it was also about this employment cost index coming in below expectations. So that inflation is what is key.
Yeah, you do wonder what inflation is and how it's going to play out, Mark. I mean, how do you see the whole thing, though? Listen, we care about Fed rate hikes. If you're borrowing money, want to get a mortgage, I get it. They matter to the stock market, I get it. Probably the tapering or the reduction of the balance sheet might be more important than the rate hikes, at least in the near term. We'll see. What are you advising, though, clients to do right now? Because all of a sudden, we're kind of facing this uncertain world, at least as far as the United States goes, where we're down, 7 to 10% on the major averages in just 21 trading days.
Well, I think that the most important thing is for investors not to panic over this period. We're trying to put it in context and say, look, we've had a period where the 10-year rate has risen very quickly, and that tends to cause a pullback in the stock market when it rises that quickly. But we're also in a period where, leading up to and in the 6 months after the Fed starts to hike rates, that's not necessarily bad for equities because it's a signal that growth remains strong, and all that the Fed does happens with a lag. So there's probably still some room for appreciation into the end of the year, and that's a key message for clients.
Quietly, the European markets have done better on average than the U.S. markets, despite the energy crisis there and some other concerns. Are you more bullish on Europe or maybe other parts of the world than you are in the U.S. right now, Mark?
Well, I think this is really a time where you have to go more into sectors and regions. And we do like Europe more, and we've had that on for some time, because it is more levered into global growth and that cyclical pickup that we think is going to happen out of Omicron. So, we're looking at the Eurozone, we're looking at energy and commodities right now, and a little bit more on value. As we think there's still going to be global growth into this year, and that's where we would want to play it.